Right, let's get cracking. What is up, everyone? We've got another lesson for you today as part of the technical analysis series. This one will be on mastering the RSI. The fun stuff before we get started: this is not financial advice. I am not a financial advisor, but I bet you have a lot of financial advisors in your jurisdiction. So if you want financial advice, go talk to them. Don't listen to a guy on the internet. So, what are we covering today as part of this lesson? I'm going to start off with some general remarks. We're going to cover what RSI actually is, and then we're going to go through the signals that it can generate and how to use them. They are not mutually exclusive. You don't just pick one and only use that. I think the most efficient use of this tool is being able to incorporate all of them in the right circumstances, as we will see. So, quick general remarks. The scope of this video is quite specific. It's about RSI. It's not about stochastic RSI. It's not about the stock. It's not about MACD. It's not about how all of those compare to the RSI. It's just about the RSI. I'm happy to cover the others later, but don't spam me with questions about other oscillators or indicators, which I haven't covered in this video. Now, the reason I wanted to make this video is A, because it's fun, but also because a lot of TA in crypto doesn't make great use of the RSI. And your analysis, a lot of the time, with great exceptions, of course, tends to be quite limited to, oversold pointing up, overbought pointing down, all that kind of stuff, which really isn't making the most of the indicator. So hopefully by showing you these alternative uses or other signals it can give you, be able to enhance the level to which you use this indicator. And again, as for adding other oscillators, you can add others. I use others. The RSI isn't sort of the end all be all. I just think it's underused in the sense that it's not used to its full capacity. So if you don't use it, maybe this video convinces you to. If you do use it, hopefully you learn some cool ways to improve your RSI game. Limitations of the tool: the two normal ones apply. The first one being it's not a magic indicator that'll just make you heaps of money. It makes mistakes. Well, what I should say is it gives you false signals that you choose to act upon. And also, in freakish markets, it's not 100% useful. So, in a bull market, as we Bitcoiners know, RSI can stay overbought for ages, and in a bear market, RSI can stay oversold for ages. So don't give religious conviction levels religious levels of conviction to this indicator, especially in really strong trending markets. So what is it? RSI stands for Relative Strength Index. It's a momentum oscillator which measures the speed and change of price movements. Great. It becomes more valuable and accurate when or if there's more price action data. So if you're trying to use the RSI on big time frames in a lot of altcoins which don't have a massive history, it may be a bit harder, but it should be fine for the most part. That's just something I'm flagging up. Another point is that you can actually change the period on the RSI, which affects, the data that it shows. Most people use the default. I do, and that's fine. But if you want more frequent signals of overbought and oversold, for like perhaps aggressive scalps, or if that's just your trading style, you can do that by lowering the period. At the same time, if you want less noise and just smooth moves on the RSI, you would increase the period. And it's probably worth covering sort of how to use it. I'm on TradingView. I'm clicking indicators. I'm typing in relative strength index. It should come up as a built-in, the top one. Add it to your favorites there, and you should get something like this. And if you want to change the period that I just talked about, yep, we're still recording, great. If you want to change the period, you just press the format button here, inputs, and do all that good stuff. Let's get back to the lesson. So the most basic fundamental thing about RSI, and where unfortunately a lot of the analysis stops, is the 70 and 30 lines, which indicate whether an instrument is overbought or oversold. So if an instrument is overbought when the RSI level is above 70, an instrument is oversold when RSI level is below 30. Murphy, who's one of my TA go-tos, suggests that in bull markets you might want to raise that threshold to 80, and in bear markets lower it to 20. Most people don't. It's fine. It's just something to be aware of, perhaps adjusting the threshold depending on the market. So now that we know about these 70 and 30 levels, how do we actually use them to generate trading signals? So if you want to go long, it makes sense to open long positions when the RSI crosses from below 30 to above 30. Okay, let's think about this logically for a second, because this is a concept you need to understand and just make the whole thing make a lot more sense, if you haven't already. So the 30 level and below is oversold. If the RSI crosses from below that level to above that level, that suggests that the market is becoming less oversold. So that means the buys are stepping in, the bulls are waking up, whatever you want to call it, and you want to sort of, and they're going to push the price up, and you want to ride that with them. So it's a good time to take a long position. At the same time, you can use that to close your short and say, okay, I've had a great run on this sell-off, but now the bulls are coming back into it. I'm going to close my short so the market doesn't move against me. And of course, the same logic applies for the other end. If RSI is above 70, it is overbought. If it starts going from above 70 to below 70, the instrument becomes less overbought, which means that the sells are picking up, the bears are waking up, whatever, and they're going to push the price down. And you want to move with the trend, with the market, whatever it may be. So it makes sense to open a short, or at the very least close your long, because you don't want to be long if the bears successfully push the price down and moved against you. Okay, so let's look at some examples. So using just the 70 and 30 levels, this is an Ethereum chart, Ethereum Bitcoin 4-hour chart. So when you open up RSI, you'll see these dotted lines right here. These are the 70 and 30 levels, right? 70, 30. So let's just look at how they behave. Here's one example. RSI at this point is at 77. So the market is overbought. It's above 70. Now let's look what happens when the RSI level goes from above 70 to below 70. So telling you to short. If you just look up and line this up, this is your 70 level. You might want to short, either here or here, depending on sort of how early you get in. And then you catch this very nice ride down to here. And then at this point, RSI is telling you to go long, because we're crossing from below 30 to above. And you do go long, doesn't work awfully well. You can see the trend is still down. And at this point, it's telling you to go long again. So look, we went above, from below to above, but it didn't really go anywhere. It stayed below 40. And at this point, the RSI, if you're just trading the extreme 70 and 30 levels, it's telling you to go long again, because it's crossing from below 30 to above. So let's see what happens. You open along here, and you catch this nice ride up. And depending on whether you're trading the extreme values, you might want to close here, or you might want to wait, whatever. That's not too important. So we've just seen a move from the overbought level, oversold, a fake out, so you'd lose money here, I believe, and then a proper move up. And as you can see, this was a trend with Ethereum where it'd go from very oversold, but it would never, for quite a while, very bearish, never really reached, the sellers never really stepped up, and Ethereum didn't really reach this zone. First it was here, then we got a higher high, at this level, but the market's bearish. I mean, if you look at the trend, we're just making lower lows and higher lows, lower lows and lower highs. Sorry. So these trades are risky anyway. If you're opening along during this downtrend, it's a counter trend trade, which is risky. So let's move to another example. Here the market's oversold again, and RSI is all the way down to 18, and it crosses from below to above. So if you're just trading the extreme values, you go long. You go long here, and for once it works, and you end up catching this move from here to here. Great. But then what happens? Another move down, below 30, the market's oversold again. If you're just trading the 70 and 30 like a robot, you decide to go long again. Below 30 to above 30, let's see, all the way here, and you catch this move. And then just the last couple of examples, you might not want to, if it doesn't reach your extreme level, you ignore it. The market's overbought here. Look at this. This RSI is at 80, which is above 70, obviously, and then it goes from above 70 to below. You open your short, and you catch this move all the way either here, before you open and long and close it again, or you just let it run all the way here and catch this move down, which is excellent. And then this, where Ethereum really starts trending, goes from, I mean, these levels are just ridiculous for RSI, but RSI is 7, and you get the cross from below 30 to above, and you catch the move from this bottom all the way to this overbought level. Okay, so as you can see, if you trade, sorry for spending so much time on that, I just think it's important to get the sort of 70 and 30 stuck in your head. But as you can see, it's far from perfect. Let me just check again. Okay, excellent. As you can see, it's far from perfect. You got some fake signals, but more importantly, more than just fake signals, you should be very careful just using the 70 and 30 levels like a robot if you're trading against the trend. So, this is a clear downtrend. So if you're taking every single one of these oversold signals to buy, sometimes you will get burned, like here. So just be careful entering counter trend, but that's not the point. The point is to explain these levels and what the signals actually look like on the chart. We've got another example. We have got Litecoin. This is the Litecoin Bitcoin 4-hour chart. Let's see how this performs. Again, you're a robot just trading the 70 and 30 levels. Oversold market here. Tells you to go long because it crosses above. You go long. Great. You get to here. Overbought market. Crosses below. It tells you to go short. And you pretty much let this run probably until this low. Great. You made money. And again, the market's oversold below 30. Crosses above from below 30 to above 30. You go long, and you catch, the RSI itself ends up making a nice uptrend here. So you catch one of these peaks. Great, you're profitable. But at this point, the market's really overextended. As you can see, RSI at 90, which takes out all these previous highs, and it's going to tell you to go short, crossing from above 70 to below. And so you open your short here, and you ride it until you hit oversold, which ends up being here. So you catch this whole move. Great, good for you, good for your profits. And then it keeps going, oversold, you ride it until here, overbought, you ride it down until maybe here, depending on how sort of strict you are with these levels. And then you go long again, then you go short until here, etc., etc. So if you were to use RSI in the simplest, most possible way, that is how you would do it. You would go long on the crosses from below 30 to above 30, and then you'd wait for it to reach overbought levels, and then you'd either just close your long and that's it, wait for the next time you get something like this, or you open a short position when the market goes from overbought down below 70. So if you're going to take anything away from this video, it's that just super simple extreme value, using the extreme values to generate your buy and sell signals. But as I said, it's worth being aware of the trend. And what that means is if the trend is up, if we're uptrending like we're on Litecoin, you should be taking these oversold signals with a lot more confidence, right? Because You're trading with the trend. Whereas as we saw with Ethereum, you should be giving more preference to the overbought signals because Ethereum was in a downtrend. So trade with the trend. If the trend is up, you want to buy or take the oversold positions because going up would match with the trend. Whereas with Ethereum, with that downtrend we saw, you would want to give more preference to you'd want to take these overbought positions because the overall trend is down and you want to ride it down. And the likelihood of that trade working for you is a lot higher because it's with the trend. Okay, hopefully that makes sense. Let's jump back into this. So that's the 70 and 30 levels. The quick summary of that is you can use those extreme values and then trade with the trend to sort of make money. And that's just about it. I think that's what attracts so many people to RSI is the ability to decide to get these really simple signals based on these two values. So let's get a bit deeper and hopefully a bit more interesting. So midpoint value crosses. Obviously, the midpoint between 70 and 30 is going to be the 50 level. And as we just saw, most traders use the extreme values to generate their signals, the 70 and 30. Now, I think you can do a lot with the midpoint value, and it's underused. So I'll show you at least 3 use cases. The first is whether there's a bullish, to indicate whether there's a bullish or bearish bias in the trend. The second is to indicate whether a trend reversal will happen. And the third is to indicate periods of consolidation. That sounds pretty useful. Let's take a look at what we have. So let's start with the bottom, periods of consolidation. Now, just as a quick note, I don't think by default TradingView has the middle line. So just take I suggest the cross here, put it to around 50. I don't think it needs to be perfect. This is about as accurate as you're going to get. And just press Alt plus H. That should paint a nice horizontal here. Cool. So I just mentioned that you can use this midpoint value to identify periods of consolidation. So how do we do that? So the way you identify periods of consolidation is that when the RSI values are just cutting through the 50 point repeatedly. So when it's just chopping through both sides of the level without a sort of clear trend or clear bias or anything else. So I mean, this is the perfect example. This is on the dollar-yen daily. As you can see in this box, it's pretty much as much, I mean, slightly more to the downside, but more or less up as much as it is down. No crazy moves either way. They're all quite equal. And just no clear trend emerging, just choppiness across the 50 level. So let's follow it. So this is the zone I'm referring to. And as you can see here, it's a perfect consolidation period on the dollar yen before it chooses to go up. So if we were to draw, very roughly these levels, something like this. Okay? It's just consolidating within this range. Consolidating here by cutting up the 50 level, and then it chooses to break to the upside and expand. So, consolidation follows expansion. So if you see on your RSI that the 50 point is just being cut up as much to the downside as to the upside in sort of no clear trend, that should reflect consolidation on the price action. And that's when you start paying attention as well, because we know that expansion follows consolidation. So you see this, you pay attention, you sort of set up your patterns, indicators, whatever else it may be, and then you get to catch a big move like this. So that's how we do consolidation. Then the other two things, and I'm going to treat them quite similar, is you can use the midpoint value crosses, or just the midpoint value generally, to indicate two additional things, whether there's a bullish or bearish bias, and whether a trend reversal will happen. So how do we do that? I'm going to close the yen. We're going to look at Bitcoin here. Okay, so let's treat this in order. Bullish or bearish bias. Now, the way I do this isn't hugely scientific. it's more of a sort of buy eye type thing. But it should work quite well. So let's go to the most recent bull run, actually. So from sort of mid-November. So the way you identify, okay, well, at least the way I identify whether there is a bullish bias or the bulls are in control of the trend or whatever you want to call it, is by looking at just eyeballing the amount of time that the RSI action takes place above the 50 level. So as you can see from sort of mid-November, all this action, all these peaks and troughs, or most of the RSI lines are above the 50 level, and the only few exceptions are these little dips here. But it does not compare anywhere close to how much price action or RSI action is happening above the 50 level. So this tells me that the bulls are in control. Now, what tells me if the bears are in control? We'll have to go a bit back for Bitcoin. Well, quite simply, it's the opposite. So as you can see here, Bitcoin had a nice, the same thing I just mentioned. The bulls are in control here. Look at how much this is a good point to use, actually. Look at how much from here the RSI action is happening above the 50 line. You have virtually no breach of the 50 line all this time. You get a dip here and a dip here, but then look at the expansion that follows. And then the same here, all this action is happening above the 50 level. And then we get to this zone. So let's see. We have the first breakdown here. It goes above, but can't keep this level. And then between, let's just do this. Between sort of here and here, a lot of the action, or the majority of the action, is actually happening below the 50 line. So, you have some attempts to get above here, but I'd say that the majority of the RSI lines or RSI action is below the 50, the midpoint way. So this tells me there's a bearish bias, or the bears are in control of the market. And if we look at price, if we align it here, you can see that the market did start trending down. It should be fairly obvious, but in case it isn't, just this kind of thing, right? It's a downtrend. And the RSI reflects this because most of the RSI action is below the 50 line. Now, what's left is, how do we identify trend reversals using the midpoint 50 line? Now, the simplest way I find to get an idea of whether the trend will be reversed, again, I'm just paranoid. Yeah. So the simplest way of thinking about this is treat the 50 line as a dynamic support and resistance. So if the RSI action is below the 50 line is resistance. And if the RSI action is above the 50 line, then it is acting as support. So how do we know if we're going to get a trend reversal or a big dip? So let's look at the most recent Bitcoin action. So going back to our criteria, the majority of the RSI action is happening above the 50 level. All of this, look at these peaks. I mean, this is just crazy. So we know the bulls are in control. And look, test as support, all these big bounces. This one is a bit deep, but whatever, still holds. Nice dip here. In general, and this is a good example as well. Look, break above, test as support, big uptrend, test as support. You can find loads of examples of on sort of bullish moves. The 50 line is being used as support for the rally. So, same here, dip, we go higher, dip, we go way higher. So how do we know if we're going to have a trend reversal? Quite simple. It's acting as support. You can get an idea of a trend reversal when the support fails to act as support. So here, for example, I think this is quite a deep dip, to be fair. So here the market's really overbought. We're coming down. We're about to test the support, and we actually break below. And this is one of the more recent, quite soft, but still corrections to keep in mind. 23% here. If you want like a really big one, this is certainly one of them, where we didn't really use this line as support. So if we go to the most recent one, we tested it as support successfully here on this dip. So you could see the drawdown here was minimal, 11%, and then we bounced to an all-time high. But when we came back to test the 50 line as support, it failed. And you see it took us a lot deeper than these two previous dips. Oh, you know, this breach was a lot more significant than this one, and it shows in the price. So, this was a 21% dip, and you see the breach wasn't as deep. This one was similarly a sort of 23% dip, and the breach wasn't as big. This breach took us to oversold levels, much like this one, and let's compare them. Level generally holds 21%. Level generally holds 23%. Level completely violated. Let's go from this high down here. Closer to 30%. And here the same, the deep violation, 30%. Generally holds 21, 23. And then the most recent one, let's go from this high. And look at that, 43% or so on the break of this 50 midpoint way. So it's not even just a question of the midpoint value acting as support and resistance. You can also get an idea of how big or how violent the correction or the bounce will be based on how far the RSI deviates from the midpoint line. So to recap, we can identify periods of consolidation where the 50 line isn't really doing much and price is cutting through it. We can identify trend reversals by using the 50 zone as a dynamic support and resistance zone, and indicate whether there's a bullish or bearish bias on the trend by looking at how much of the RSI action is above or below 50. Above means the bulls are in control, there's a strong bullish bias. Below is the opposite. Hopefully that makes sense. And again, even though I've covered this, applying these principles, you can open long positions when RSI goes from below to above the 50 value and is able to keep it. You can also close your shorts. And then for short positions, the opposite, as we just saw with Bitcoin. The only note I'll make is, with the midpoint value stuff, if you use timeframes that are too low, everything will kind of look like consolidation, because it'll just be chopping the 50 level up and down, and won't give you too much useful data. So for this use case specifically, I recommend the 4-hour and daily timeframes to get like a macro perspective on what RSI is doing. Now, the next sort of signal tool, whatever you want to call it, I want to cover is trend lines. This should be fairly brief. The basic principle is you should treat the RSI indicator kind of like a line chart. And you can just draw your good old standard trend lines on the RSI like you would anything else. And I use RSI trend lines not in 4, but in 3 main ways. There's some fake news, okay? In 3 main ways. Identify the trend of the instrument, in case it isn't obvious by the price. Confirm a breakout or breakdown of a pattern. And indicate trend reversals when RSI breaks resistance or support lines. So the examples will make this a lot more understandable, but the basic premise is just draw your trend lines on RSI like you would for anything else. So let's look at some examples. This is one of my more recent Bitcoin charts when we were still hovering at around 12K. And this example shows you what I mean by identifying trend reversals. Ignore this. This is about the midpoint cross. It's not as important. The main where I want you to pay attention is this downtrend line. So this is a downtrend resistance line. The RSI is making lower highs, and that's what I'm pointing out with this line. And what I mean by this circle is one of the signs of a bullish trend reversal would be if RSI is able to break above this line and thus invalidating the RSI downtrend line. And it did, and look what happened. So look, price is at 12.5k here, and it's still not broken. And look, it's a dotted line now because it's broken, and price is all the way up at 15.3. So that's just one very recent example of what I mean by RSI trend lines and how to read signs of trend reversal using them. Let's quickly look at how you could confirm a breakout or breakdown of a pattern using RSI. So this isn't the best example, but I kind of just liked how powerful it was. So this is on the daily chart with ARK, and you can see there's a really clean textbook ascending channel on ARK. And if you look at the price, this is sort of where it takes us on this journey up, you know. And if we sort of pay closer attention, test of support, bounce, test of support, bounce, test of support, bounce, doesn't test resistance, test of support, bounce, and then we have another test of support, which we've tested 3 or 4 times and has been active since quite the early days of the coin, and it falls through. And what happens when it falls through to price? It starts this is the point at which the RSI trend line is breached, and the effects are significant. You get this long downtrend, bounce, another downtrend, and now showing some signs of life. But this is what I mean. I mean, you would draw, if you had a chart which looked like this, you would draw this channel just like anything else. So draw it on the RSI, and as you can see, once key levels are broken, even on the RSI, here, the price will also give you a reaction. And this fits into one of my broader trading beliefs, that breaches of significant levels will give you more violent and more profitable reactions. And this is a perfect example. Long-term ascending channel, well-established support, broken, and it causes this long-term downtrend in the instrument. So that's what I mean by sort of confirming patterns. And a lot of the time, it's not even this. You'll sort of see me draw. I don't think this is a particularly good example, but I'll draw like a triangle on the price, and there's the RSI will also form a triangle. And if they both break down, I'm more convinced that it is an actual breakdown as opposed to a fake out. Oh, and of course, so we've covered indicate trend reversals by looking at the Bitcoin example and breaking the downtrend resistance. We've covered confirming a breakout or breakdown of a pattern with the channel example on ARK, which was very powerful. And then quite simply, the trend of the instrument, we can just see here that RSI is making higher lows and generally higher highs as well. But, you know, this is the more important one because it's recovering from a downtrend. I want to be seeing higher lows, and you can clearly draw it on the RSI, and the instrument, of course, reflects it. Another interesting point is this is support. This is a support zone, so I know that if it sort of comes down to, well, let's say to the trend line, it's not just like a sort of support in the air. I also expect the RSI trend line support to be tested as well. So it sort of adds a bit of confluence to your price action trend line. So we've covered all 3 of those. Let's keep going. So I think this is the most powerful tool you can have in your RSI arsenal, and that is divergences. The basic idea of a divergence you can figure out from just the English word, which is where the oscillator shows you something different than what price is showing. So it diverges from the price action. It does not follow price. And these divergences can give traders hints about the strength or weakness of the current trend, and thus give us very profitable counter-trend positions or if you're more risk averse, give you an idea of when you can expect to take a long position or a short position. Basically, when the current trend is going to run out of steam. And I thought this was an interesting quote from Wilder, or Wilder, probably butchering his name, the guy who came up with RSI. And he says the single most indicative characteristic of the relative strength index. So if you're not using divergences in your RSI analysis, the creator is very upset with you. So let's get to it. So there are two categories of divergences: normal/standard and hidden. This one is probably worth just screenshotting or saving or whatever else. There's also a sort of divergence cheat sheet on baby pips you can look at. So whatever you need to do just to have these in your mind, but it's going to be a lot more useful to go through some examples in a sec. And then I use RSI divergences in three main ways, but it's kind of more like one. So in a downtrend, I want to find out or want to have an idea when the downtrend is going to end, or at least when the strength of the downtrend is fading, so I can take a either counter trend long position or know that, hey, the trend is going to change soon, and when it changes, I want to ride it the other way. So in a downtrend, you're waiting for the bears to get tired, and an uptrend, you're waiting for the bulls to get tired. As I mentioned here, it's generally to avoid buying the top or selling the bottom. So, if something's on a huge uptrend and you get your FOMO itch and you're like, oh man, this is just going to the moon, I want to hop on, but then you see a bearish divergence, that gives you a hint that the party's almost over. And similarly with a downtrend, when you're thinking, oh man, this bag is so heavy, I'm about to dump, it's just going to go to zero, and then you see a bullish divergence, that should give you some hope that the bears are getting tired and there's upside to be had. And then for those of you who follow my Twitter, I tweeted about I think I'll cover this. Do I cover this? Yes. Let's get to the chart examples here, actually. So let's get rid of XLM. So this is the chart I posted on my Twitter. When price was $18,000. So these are all, according to our criteria here, which I didn't expect to memorize, but this is a bearish divergence. So price is making a higher high, and the indicator, or the oscillator, is making a lower high. So this should be quite simple. So price, this is a high, and this is a high, the high is higher. But look at all these oscillators saying otherwise. The RSI made a lower high, momentum made a lower high, and the ultimate oscillator made a lower high as well. So what this tells me is that the bulls are getting tired and the uptrend is weakening. It's a bearish divergence. And as we all know, it played out quite nicely. So let's look at an example of a bullish divergence. And shout out to my homie Andrew Emmerich Jr. Sorry if I've butchered your name. This is the gent who I pretty much learned this from, and he's just sort of the master of divergences on high time frame. So here you have Zcash on the weekly chart. And if we go back to our criteria, a bullish divergence, a standard one, is where price makes a lower low and the indicator makes a higher low. So, does this fit the criteria? Price, this is a low and this is a low. It's a lower low. At the same time, the indicator, in this case the stock RSI, is making higher lows. So it's a bullish divergence, and as you can see, price is taking off quite nicely at this point. Now, let's get to hidden. So those were sort of standard, by our criteria, these were the normal standard divergences. Let's look at some examples of hidden divergences. So, this is one I had for OMG. Yeah, this is one I had for OMG. So let's look at our criteria. A hidden bearish divergence is where price makes a lower high and indicator makes a higher high. This is a high. This is a high, which lines up with these. Price made a lower high. This high is lower than this one, lower high. But if we line it up, sorry, if we line it up, which we do here, look, these points line up, the ones I just talked about. Price made a lower high, but the indicator actually made a higher high. Just to go back and check, it's a hidden bearish divergence. And as you can see, and this is on the 2-day charts, this is quite major. Lower high, higher high, bearish divergence, and we had more downside. Now, shout out to Cryptopius. He's in my Telegram group, which is free but closed at the moment. And he posted, after I messaged the group about sort of the importance of divergences, he posted this saying, "Is this a bullish divergence? A hidden bullish divergence?" Well, let's check. Price has to make a higher low. Indicator has to make a lower low. Price, this low is higher than this low, so price is making a higher low. At the same time, look, these line up. The indicator is making a lower low. So this is a hidden bullish divergence which happened preceding a breakout point. How did it play out? Amazingly. I mean, look at this move. Great. And that told him, before any breakout, before price even reached the apex of the triangle, that there is a hidden bullish divergence, as he identified, and obviously that worked out quite nicely. So, yeah, those are the examples. Let's go back to the slides. So how do I use them? Hopefully it should be obvious. And I've talked about this. Identify where momentum is fading either way, and to avoid buying the top or selling the bottom. So the last and final RSI tool I'll be covering are failure swings. I think this is one of the more complex ones, but I think it's fascinating once you get a good look at what one looks like. So the basic premise of a failure swing is that at extreme values, which we know is 70 and above or 30 and below, the RSI fails to make a higher high or lower low and reverses in the opposite direction. Now, reading this will just give you a headache, but the examples make a lot of sense. So there are two types, a top failure swing and a bottom failure swing. So let's look at them. These are our criteria, which we're going to refer to. So this is a top failure swing on the US dollar and Korean won. So, as we know by our criteria, the setup needs to take place at an extreme value. So, you see price makes a high, and then it fails to make a higher high. But before we go there, let's see. Price makes a high, it retraces and paints this low. It goes up and fails to break this level that was set by the previous high. And then on the retrace, it takes out this level, and we see it go all the way down this move here. So, does it meet our criteria for a top failure swing? Peak in RSI over 70, yes. Fails to exceed previous peak in uptrend, yes. Breaks a previous bottom from this retrace, takes out this level, and retraces to close to oversold levels. So this is a perfect example on the 2-day chart here of a top failure swing. The names get jumbled in my head, of course. And what you would have caught is on this attempt to make a higher high, and when it takes out this low, you'd be saying, hey, this is a sort of toppy bullshit move. I'm going to take a short position once this low is taken out, and it would have been very profitable catching this move all the way down here. So let's look at an example of a bottom failure swing, which is the same principle but the opposite. RSI bottoms out here. It bounces and paints this top. Okay? And then when it goes back into the extreme value, it fails to make a lower low. Okay? And then what happens is, coming back up, it takes out this level, which was painted by this bounce, and that's your bottom failure swing. Let's see if it meets our criteria. Bottom in RSI, under 30. Yes, this is all happening in the extreme value. RSI fails to set a new low. This is the first low. Did it set a new low? No, because this level is higher than this one. And then breaks a previous top. Bounce, painted this top, fails to make a lower low, and then takes out this level. And taking out this high is your signal to go long. And as you can see here, ended up being a very nice move and letting you know that, hey, this is the bottom. Once it takes out this level, so two parts to it, fails to make a lower low. Check. Does it take out the previous high? Check. And that's your signal for reversal. Pretty neat. So, what do I actually use it for? Hopefully it was obvious. I use it in three main ways: to avoid buying the top, to avoid selling the bottom, and indicate a trend reversal. And as you can see, there'll be a lot of overlap between divergences and failure swings, but it's another way to identify trend reversal and to sort of get an idea of whether RSI and also price will bounce. Okay, conclusion. Wow. So about timeframes, the normal type rules apply, I think is fair to say, which is that the time frame that you're using should reflect the sort of time frame you have in mind for the trade. So if you want something to play out over the next few days, you shouldn't really be using the hourly RSI. At the same time, if you want to go for a scalp in the short term, you shouldn't be using the daily RSI. I'm more biased towards higher time frames. For one, that's because of Andrew Emmerich Jr., who spots the most ridiculous divergences on like 1 hour, 2 hour, 1 day, 2 day, 3 day, weekly charts. And also just because that's kind of how I've been trained. But as you saw from the early examples of the 70 and 30, you can use all of this stuff, except maybe the midpoint crosses that effectively on lower time frames. So just pick the time frame that fits the kind of trade you're trying to make. Putting it all together, this goes back to my original point. Now that you're armed with all these tools, don't just rely on one, if you can avoid it. Don't just trade 70-30. Don't just trade divergences. Don't just look for failure swings. You should, be open-minded and see what the chart and what the indicator is telling you, and then apply, ideally, more than one of the tools you learned to get confirmation. And on the topic of confirmation, you obviously can use confluence with other indicators and tools in your TA arsenal. So for example, if you know price is approaching a key fib level or a key cloud support, and you see a bullish divergence, that can signal to you that, hey, this bounce is more likely to happen. Or at the same time, if price is approaching a key resistance, which you have from your pattern, trend line, fib, whatever, and you also see a bearish divergence, that can act to let you know that, hey, the likelihood of a breakout is a lot less likely. So yeah, ended up being quite a long lesson, but I expected it to. I spoke more slowly in this one and in more excruciating detail to hopefully get the point across. I hope it's helpful. So this is my 5th lesson. I think if you get a good grip of all 5, you'll be in a really good spot to be more self-sufficient with your TA. And of course, if you enjoyed this lesson or my 4 other ones, or my work generally, I've left some tip jar addresses there. And thank you for your kindness for those who intend to fill those jars. And just a general thank you to you guys for the crazy support over these weeks, months, whatever. And I look forward to providing more value to you and interacting with you all. Thank you very much. I'll see you for the next one.